We've seen bank rate reduced to close to zero, and the Monetary Policy Committee embark on a series of asset purchases, often referred to as quantitative easing or QE, to stimulate the economy further. Now, your article discusses a number of myths relating to how QE affects the money supply. Now, QE serves to increase the number of reserves that commercial banks hold at the central bank. But the first myth you discuss is the idea that this in some sense represents free money for banks. What's wrong with that account?
Well, it's true, as you say, that QE will lead to an increase in the reserves that banks hold with the Bank of England. But if you consider what's going on the balance sheets of the parties involved, you can see that it's not really free money. The main point is that QE mainly involves buying government bonds from pension funds and other asset managers, not from banks. The main point is that QE mainly involves buying government bonds from pension funds and other asset managers, not from banks. Not from banks. From pension funds and other asset managers. The pension fund in this example will receive money in their bank accounts, shown here in red, in exchange for those government bonds, shown in purple. The banks simply act as an intermediary to facilitate this transaction between the central bank and the pension fund and other asset managers, not from banks. The additional reserves shown in green are simply a byproduct of this transaction. QE affects the economy mainly through the extra bank deposits that pension funds and other asset managers end up holding. Those asset managers will use those deposits to buy higher yielding assets, such as the bonds and equities that companies issue. That will raise the value of those assets,